Hello and welcome to the Money Goose podcast. Thank you for joining the both of us today. In this episode, we will be talking about credit scores and how they impact your financial journey. Whenever I hear people talk about credit scores, it always sounds so mysterious, like some secret number that determines your financial fate. Can you break down what a credit score actually is and why it matters so much?
It really does have that aura. But at its core, a credit score is just a three-digit number that tells lenders, landlords, and even insurers how risky it might be to do business with you. The higher your score, the more you're seen as trustworthy, which means better access to loans and lower costs.
So it's not just about getting a loan, your credit score affects way more than that.
Exactly. It can influence everything from your credit card interest rates to whether you need to pay a hefty security deposit for your next apartment. It's like your financial reputation summed up in a single number.
Now, I'm curious what goes into building that all-important number. It feels like there are a lot of moving parts.
There are. Lenders look at things like whether you pay your bills on time, how much of your available credit you're using, how old your accounts are, how often you apply for new credit, and the mix of credit types you have.
That sounds like a juggling act. Does one factor carry more weight than the others?
Definitely. Payment history holds the most weight, about 35% in the most common models. Next up is how much you owe, or your credit utilization, which is roughly 30%. Together, those two drive the lion's share of your score.
You mentioned models like FICO and Vantage Score. Are those just different flavors of the same thing, or do they actually matter?
Oh, they matter much more than people realize. FICO is the classic one you'll hear about. Its 35 divided by 30 divided by 15 divided by 10 divided by 10 breakdown a lot. Vantage Score is a big player too, but tweaks how it treats things like recent activity or medical collections.
So, could applying for a new card make a bigger dent in one model than another?
That's right. And some lenders, especially for mortgages, will actually pull all three of your bureau scores and use the middle one. Plus, newer models even look at trends over time, not just your current snapshot.
It's wild that a few points can have huge consequences. What kind of real life changes can a small score jump make?
Let's say you move from a 680 to a 720. On a $250,000 mortgage, that could mean a $148 lower monthly payment and save over $50,000 in interest over 30 years. Even a late payment or a drop in utilization shows up fast in your score.
Wait, $50,000? That's not pocket change. So managing your score isn't just about pride, it's about real money.
Exactly. And the changes can be quick. Pay down a credit card, and you might see a score bump in just one billing cycle. It's one of the few financial levers you can pull for almost immediate impact.
I always see those score bands like good, fair, or excellent. Why do lenders divide things up that way?
It's all about risk management. Lenders price loans and credit cards differently depending on your score band. 300, 579 is considered low. 580, 669 is fair. 670, 739 is good. And above 740 is very good or excellent.
Switching bands can't be that big a deal, can it?
It's actually huge. Just moving from fair to good can mean access to mainstream loans instead of subprime options, and a lower rate on a mortgage or credit card can equal thousands in savings.
Let's talk about the tough side. What happens if your score drops below 580? That sounds scary.
It's definitely challenging. You'll pay higher interest, might be denied for loans, or have to put down big security deposits for things like apartments or even utilities. Insurers might hike your premiums too.
Is there a way out if someone gets stuck there?
Absolutely. Secured credit cards, credit builder loans, and paying down balances can show quick results. Even becoming an authorized user on a responsible account can help. Sometimes you'll see a meaningful lift in just a few months.
Okay, so what if someone's in the 600 seconds or low 700 seconds? How do you move up from fair to good or higher?
Great question. The fastest wins are lowering your utilization below 30%, ideally under 10%, and making sure you don't rack up too many hard inquiries. Asking for a credit limit increase can sometimes help too. Just make sure it doesn't trigger an inquiry.
That's a good hack. Does diversifying your credit types actually make a difference at this stage?
It absolutely can. Adding a small installment loan or keeping older accounts open gives you a score boost. It's like signaling to lenders you can juggle different types of credit responsibly.
Let's talk about the flip side. What's life like if you hit that 740 plus excellent zone?
You're in the financial VIP section. You get the lowest rates on mortgages and auto loans, premium credit card offers, and even lower insurance premiums. It can literally mean hundreds in monthly savings.
But I bet it's easy to get complacent once you're there. How do you keep your score in that top tier?
It's about consistency, keep utilization low, don't close your oldest accounts, and pay in full each month. Using your cards to earn rewards is fine, as long as you never carry a balance you can't pay off.
That reminds me, how does your credit score actually show up in day-to-day spending, not just big stuff like mortgages?
It pops up everywhere. With a strong score, you get the best store financing deals, 0% intro APR offers, and sometimes even skip security deposits on your phone or utility accounts. With a low score, you can get stuck with high interest payment plans or upfront deposits.
So, a low score can make your everyday purchases more expensive without you even realizing it?
Exactly. Even carrying a $1,000 card balance at a higher APR adds up. Those extra interest costs sneak into your budget over time.
When it comes to bigger loans like a mortgage or car loan, how much difference does timing or refinancing make if your score jumps?
The impact can be dramatic. Improving your score by just 50 points before applying can move you into a better rate tier, sometimes shaving $100 or more off your monthly mortgage payment and many thousands in total interest.
That's wild. So, even waiting a few months to refinance after your score improves could pay off big?
Absolutely. Lenders have these rigid cutoffs, so a small improvement can unlock much better terms. It's worth being strategic about when you apply or refinance.
I hadn't realized until recently, but your credit score matters for investing too, right? Like, not just for personal loans, but for growing your wealth.
That's spot on. A solid score unlocks cheaper capital. Think better mortgage rates for rental properties, lower margin rates, or business credit lines. The difference can mean tens of thousands extra to invest or keep working for you.
Are there hurdles for investors if their score isn't up to snuff?
Definitely. Lenders might require higher down payments or stricter terms if your score is under 700, especially for investment loans. And if you hit a margin call, weak credit can make things even tougher.
All right, let's get tactical. If you wanted to boost your score fast or just keep it healthy, what are the biggest moves someone can make?
First, always pay bills on time. That's the foundation. Next, keep your credit utilization low. Aim for under 30%, but under 10% is even better. And definitely check your credit reports for errors. Disputing mistakes can bump your score almost immediately.
What about people just starting out? Is it worth becoming an authorized user or opening a secured card?
Those are fantastic ways to start. Use the card responsibly, pay it off in full, and don't open too many accounts at once. Keeping older accounts open also helps your credit age gracefully.